We'll let you start, Jessica.
Sure. So, hi, Phil. My name is Jessica Rorson, and I'm working with the IBDS program and with Sagehill, just coordinating these workshops. So we've had several so far, and today is going to be about financial statements that Sherilyn Walters is going to be facilitating for us. So I will just pass it on to Sherilyn.
Hi, Phil. So I'm a consultant with Indigenous Business Development Services, and in partnership with Sagehill. And so this is our way of trying to reach out and network with people from all over the province. So now that you're finally here, I appreciate that, because I was going to have to present just to Jessica and Jenny, and thought that's not going to be good at all. But now I'll ask you all the questions as we go.
Sure.
Do you want Phil to introduce his business to you again, Sherilyn? I know he was on one of our other calls, but why don't you tell us a little bit about your business, Phil?
Yeah, my business is more or less consulting, robotic automation and consulting for people looking at automating or adding robots to their production facilities. That's kind of where it started. It's more or less based on my experience and history. And the fact that I don't want to move back to Ontario. So,
so are you actually producing any of these robotics?
I partnered with another company, and we built a machine, but you basically buy the components, put them together, and then install them for the customer. So we put a robot system together that stacks wood chip bags, if you'd believe it. I didn't think there was a big call for that, but this company out of Prince Albert, 40-pound bags, 2,500 bags a day of wood shavings. And they were stacking them all by hand. So they have issues with keeping guys on, and they're opening and closing the doors, and weather issues and different things like that. So that was one that we did actually do. But anything from that to actually being subcontracted, I guess, to an electrical company who was helping my neighbor, or basically he put in a system to basically the feed mill for a feedlot. So there's a PLC controller, which is a programmable logic controller, small brain, I guess, that takes the information, turns on certain motors and different things to get the electronics and things going. Most of my background, though, was in welding and heavy ag manufacturing. So yeah, I also have a few support calls that were called into tillage tools locally as well, when they couldn't get something going, or their own electricians were troubleshooting it, and they called me in and I could help them out.
Wow, sounds really interesting all the way around.
It's a little different. It's a little bit of everything, but it's keeping me a little busy anyway. So
that's good. Okay, if you guys are ready, then we'll get started.
Yep, I'm recording, so you fire away.
Okay, so the first thing that I guess that before we even get really into it, one of the things that I want to explain when I talk about financial statements, we are actually only talking about your income, or sometimes they call it profit and loss statement, and your balance sheet. So in one of the earlier sessions, I showed you how to create a cash flow statement. That cash flow statement is used in the creation of your income statement and your balance sheet. So just hang on one second. So did you are you seeing a cash flow statement right now?
yes.
Okay, good. Have you ever done one?
No, because what was happening, the way my business was set up, is I more or less had to create it, and we only got paid once the machine was delivered. So as far as paying myself hourly or anything like that, and then I did incorporate instead, thinking that there was some liability things and different things that I thought of, but I have not done one of these yet.
Okay, well, you should go on and watch the YouTube video on how to do a cash flow statement, and you really should do one, especially if your business is going to take off on you, and it sounds like you've got some pretty good opportunities. You have to have this cash flow statement, even though it's not considered an actual financial statement, if you're applying for money. Everybody wants to see what you're projecting to occur in the next 12 months of your business. But on top of that, everything that you put into a cash flow statement, every one of those line items gets transferred over to create an income statement or creates a balance sheet. And so if you're looking at them now and you're saying, okay, this is where I think I'm going to be at the end of my first year of business, then you can actually use this to do a lot of your troubleshooting ahead of time, and you'll kind of see how it ties in. But if you take a look just on the bottom of the cash flow statement, oh, I can't do that. Okay, just on the bottom, the numbers that are in red. Okay, so that indicates to you that you are not generating enough money in that month to cover the expenses. And so it really helps you from an owner's perspective to manage that and say, okay, what do I need to do in March to increase my sales, either of a product or a service? And so in your case, you have both of those. You have a product, which is the actual physical robotic that you put together. And of course, the service, which is your knowledge and experience in being able to do that, and also being able to go in and consult with the companies. The number across the bottom is your cumulative cash, okay, month over month. And so although I actually am in the red 5 months out of 12, I haven't make enough money in the good months to still have a reasonable amount of cash available for me at the end of the year. Okay, so that's what that is. That's what the statement looks like, so it's not strange to you, and you'll see it again later in the slideshow. Okay, so now this is not. Okay, sorry, you jumped ahead on me. I gotta watch where my hands are. So the important thing to remember about the income statement is when someone else is looking at it, or when you're looking at it, what it tells me is how much money you're actually making in relation to how much it's actually costing you to do this. And so, and is it realistic? So when I look at a projected income statement, which is like you're projecting what's going to happen in the next year or in your first year or whatever that is, I look at those numbers, and so does I'm not a banker, but the bankers look at them and they say, are they reasonable? Does it make sense? And when I look at the rest of his plan, what's his marketing plan look like in order to generate that kind of money? Okay. As a sole proprietor, now I know you're incorporated, but the principles still apply. As a sole proprietor, the income statement is actually lets you know ahead of time what your potential income tax hit is going to be and how much CPP you're going to owe. And there's a way for you to calculate that so that you can figure out ahead of time. And later on, we talk a little bit about how many businesses actually go under because they aren't preparing to pay their income tax. And we always hear them say, yeah, but there's no money in the bank. Well, that doesn't matter. You took the money, you pay taxes on the money. Okay. The income statement also includes depreciation on any of the equipment that you have. We'll talk about that a little bit later as well. But depreciation is a non-cash item, but you are allowed to use it in your income tax or in your income statement for tax purposes. Because if you have a lot of equipment that you've invested money in, a portion of that can be claimed as an expense and drive down the amount of tax that you actually have to pay. The other thing that you need to be aware of is that you cannot and should not put your principal payment. If you have a debt amount, the only part that goes on your income statement is the interest you pay on that debt, because they're not going to let you drive your taxes down on the amount that you're paying back, only on the interest. So any investments that you make, your interest is actually a write-off. Okay. Oh. When we take a look, and again, these are the reasons that you would use your income statement. And I would suggest in the beginning that you at least produce one quarterly. You might want to produce it monthly if you actually are putting all of your bookkeeping records into an electronic program like QuickBooks or Simply Accounting. Then it's just a touch of a key, and you can produce this statement and see where you're standing. But again, it is the statement that is used to determine how much income tax you're going to be required to pay and what your CPP contribution has to be. Because even as a sole proprietor, you have to pay CPP. It's not an option, okay? It also gets you to take a look at if you have over or under expenditures. And so if your overhead, for example, represents too high of a percentage of your total revenue, that's an over expenditure. So you've got to take a look at what strategies you put in place in order to bring those costs down, and then of course obviously become more profitable. Okay, as I talked about, it's depreciation. But the one thing that you'll notice about depreciation is that there's different percentages for every different, like furniture and fixtures or computer equipment. It depreciates at 35% a year, and only half of that amount in the first year. But 35% a year doesn't take very long until that equipment actually has no value. And something like electronics change so rapidly, as you would know, that by that time, I mean, it's already too old. So it gives you a clue that, hey, you better start looking at having some money set aside to purchase additional capital assets. The other one that's good, and especially in your case where you have a product, is it helps you to monitor your cost of goods sold. And so I've seen lots of situations where people are, well, farmers market is a really good example, where they're pricing their goods at what they think is fair market price, but they're not including all of the real costs that went into the production of that, right? So they end up actually doing a lot of work, but not making a lot of money, bottom line. But on the other side of that, I mean, I've seen carpenters and furniture makers who are not counting the total cost of, or are counting the total cost of their goods, adding in the time that it takes them to build it, and then they've outpriced themselves in the market. So you've got to really be paying attention to where that balancing act is, and then you can obviously adjust accordingly. The other thing that I like about the financial statements, I use the cash flow statement all the time, but about the income statement is that it does give me an idea about what kinds of expenses I could possibly be incurring in the future. And of course, because we use electronics and computers a lot, we're always watching to see how quickly they've depreciated. What's been our repair costs are we looking at? Do we just write it off and get rid of it? Like we just had to do that with a big Xerox machine because it had depreciated almost completely. It was still operating until one day it decided not to. And the cost to repair it was not worth it. It was worth it for us to save money for a year and then buy another one. Okay, so it gives you those heads up a little bit. And of course, it is a measure of the profitability of the business over time. This is a really simple example, but just to give you a little bit of an idea. So if I'm looking at a statement, this is what I'm seeing. And I always put it a percentage against each of the numbers. And the percentage is that number against the total revenue of the business. So my product sales are 83%, and my service sales are only 16%. And so that brings me a question is, what should I be doing, or what could I possibly do different to increase the amount of revenue that I can get from my product sales? Or am I spending too much time there, and should I be focused more on my service? Should I be focused solely on my products and getting most of them out the window? So you'll be looking at that same thing as you continue to advance, because you're generating revenue under two very different streams. One is very tangible and it's your product, but the other one is all the support services that you provide afterwards. And so as you start to grow, you'll be watching those percentages to see if in fact they're increasing. And is my service becoming more valuable than my product, right? I don't know what that answer is going to be. You probably have a better idea. And then right there, it shows you the cost of goods represents 34%. And so what that actually tells you is that 34.17 cents of every dollar that you make goes into the production of a product. So you know, that's what those percentages tell you. And you have to ask yourself, is that 34% reasonable? Or should I be looking at ways that I could actually reduce the cost, my input cost? And that's why you'll often see the people will go to places like China to have products manufactured so that they can reduce their cost of goods and increase their gross margin. Okay, and then the same thing applies at the bottom where we're looking at expenses. And you say, which of those may in fact be unreasonable? And of course, my overhead is unreasonable. So then I just have to take a look and say, okay, are there things that I can do to reduce the cost of my overhead, but still maintain the quality of the product or service that I offer? So again, it's very simple example, but just to show you how you want to start looking at your own income statement, whether it's monthly or quarterly. And again, just a reminder that to actually get those percentages, it's that number over the total revenue. Okay, and the expenses are the exact same. It's that number against the total revenue, because you're comparing everything to the total amount that you're able to earn. Okay, so these, and they will be sending you out a copy of this presentation, so you'll have the opportunity. But you see right at the very beginning, the cash flow statement is where you start to begin to produce your income statement. Okay, and so everything that I identified in my cash flow statement, in my revenue streams or cash in streams, automatically gets transferred over into the revenue side of my income statement. And everything that I have in my expenses automatically gets transferred over with a few changes. Only the interest from your debt or your payment is transferred to the income statement. The principal ends up actually on your balance sheet. And depreciation, which doesn't exist in a cash flow statement, gets added as well for tax purposes. Does that make any sense to you at all? Yes?
Somewhat, yep.
Okay, you'll see as we go.
Yeah, I'm a little fuzzy on some of the depreciation. For instance, I bought a truck off of myself. So the company bought my little truck so I can drive around to all these places. But the value that's left in the truck, it was more or less a total write off, I guess. Or is there only a percentage that I can write off of my vehicle per year?
For the first year, it's 50% of the amount of depreciation. But okay, so did your company actually did your company actually pay you real money? Oh, it did pay you real money. Okay.
Well, I hadn't been paid, so I've basically been fronting it, but then I had to transfer the vehicle ownerships and everything into the company name. So I sold the vehicle to my company for actual money that I didn't get until I got paid from a job. So
okay, yep,
it does show an actual transfer of the 3,500 or whatever, which is not much. And
so you would just be able to, if you sold that vehicle on the market other than to your company, would it be 3,500?
That's what I was estimating it to be. I was looking around for other little trucks, so I kind of kept it at that. But
so that's fair market value, and now you can depreciate that, but you have to depreciate it. But in the first year, off the top of my head, I'd have to guess and say probably vehicles are depreciating at about 30% a year. Okay. But if you go on to just Google depreciation rates for Canada, and it'll tell you exactly what a vehicle, what they believe the life of that is, life of that item, and how much you depreciated a year. But in your first year, you can only depreciate half of it. Okay? And so then let's just say for it's 35, let's just say it's was $350. You would only get to depreciate 175 of that. And so then in your next year, it would be the $3,500 minus the 175 times the 30% would be the amount that you would get next year
In depreciation of that asset.
in depreciation of that asset.
But the original purchase or expense of that asset still goes in your expenses.
You can't, anything that is an asset like that, a vehicle, you can't expense it out in the first year. You have to depreciate it over the estimated life of the vehicle. So your company paid it out, but your company doesn't get to claim it for tax purposes to claim the whole 3,500 in the first year. It only gets to claim the depreciated amount. So it will claim that expense over a longer period of time. Does that make sense?
Yes, because I got the same thing with my laptop and different things like that that I bought for the company, right? But business cards and stuff like that would be different. Those aren't
Yep, business
necessarily
cards,
assets, right?
you expense them out. Yep. Usually the rule is if something costs you between or 250 or less, you expense it out in the year. Now that might have even gone up to 500, depending on what the item is. Then you expense it in the year that you purchased it.
I know
But
every
anything,
accountant, I know we find some accountants, sorry to interrupt, they say the 500 is kind of that magic number, but your accountant at the end will kind of tell you what you can use, but we do see 500.
yeah. So, and it really depends, but your business cards, that's just straight office supplies.
Right.
Okay.
Laptops, not office supplies?
No, laptop is not. And did you actually purchase that for the business, or again, did the business purchase it itself as an incorporated entity?
I'd have to go back to the date that it was bought, but I was paying for everything on my credit card at that time because there was no revenue.
Okay, so
The company did pay me back, so that's...
Okay, so if the company paid you back, then it is the company's asset. If you ended up purchasing a large item, okay, and the company didn't pay you back, then that's considered your owner's investment into that company, right? And so it's there, and it's always there. And as a shareholder or as a incorporated company, you can actually get that money back at some point in time. But for right now, it at least recognizes that you purchased it, and that you are claiming owner's investment in your business. Okay. Okay. So now I need to ask you another question before I move on, and this is just so as you're the only owner of your incorporation.
Yes.
Okay. Are you paying yourself a salary?
No.
Okay. When you start to pay yourself, you don't pay yourself an hourly wage.
No.
You pay yourself a salary.
I was told that it's only dividends then.
Well,
When
it
I was
might only
looking
be
into it, you can only do it without having a regular monthly, because I don't know what it's going to be from month to month, or based on outings to try to get more work. Up until the point, like for instance, this one job ended up being $25,000 worth of that I billed out. And I got that all in one lump sum. So I hadn't been paying myself up until that point. This is like 6 months later, because I've been traveling to the work site, getting the machine up and running. And only once it's finally bought off and on the customer's floor is the final amount that was paid.
okay. So in your startup, I can understand if the company isn't generating enough revenue to pay you on a regular basis. There's two things that happened there. One is that there should have been a personal expense recovery. Remember, you're not your company, okay? Your company as an incorporated entity is an entity in and of itself. You are simply someone who works for that company. So you're going to both get treated differently when it comes time for tax purposes. So but you could be paid your expenses, the cost of traveling back and forth, right? Whether if the vehicle was yours at that time, then it's usually mileage. If the vehicle belonged to the corporation, but you were paying the gas, then it's just the out-of-pocket expenses. So you're just being given that money back, and therefore it's not considered income to you. It's an expense recovery. Okay. But any money that you take for your time, that's considered personal income to you and is taxable. Okay. Okay. So then the other thing that you'll have to be paying attention to is the CPP. Now, as the owner of the corporation, you don't qualify for EI, right? But you do have to pay CPP. And as you get yourself more established, you need to start putting money into your pension plan. And like even the Saskatchewan pension plan, I think you can put, I'm not sure, it might even be $6,000 a year now that you can put into the Saskatchewan pension plan. And that's like setting up your own pension plan, because you're not likely, unless you get big, going to have a benefit program. Okay. So you want to be thinking about that. You also want to be taking a look at I think it's like some type of a disability program for yourself, or like a health program, like I think it's called, I don't know, I can't remember. Well, GMS, group medical insurance, okay, something like that, so that if you're injured, you're protected in that way. Otherwise, you're 100% dependent on your pension, okay, money that you have in the bank, or social services. So this is when you want to start planning ahead, okay? And you also want to make sure that you're putting enough money aside to pay what you're anticipating to be your taxes and what you have to pay. And you have to pay CPP monthly, and it roughly about 0.056 of every penny that is paid out, okay, to you. Okay, now this is, I know these numbers are small, and that's why I hate PowerPoint, but this is the same cash flow statement that I showed you in the very beginning, and there's just a couple things that I want to point out so that you can actually see. So the first one is, because this will pop up later, the loan payment, which is for $10,368 in the year. Okay, so this is a $50,000 loan, and that number that shows up on the cash flow statement is the interest and the principal, because the cash flow is exactly that. It's actual cash coming in and actual cash going out. Right? That number will appear later, part of it on your income statement, which is the interest portion of that, and the other half, which is the principal portion of that, will show up on your balance sheet. Okay? The other number, because when we get to the actual income statement, you'll see a difference. You see the number at the second line from the bottom, where, well, they both say the same thing, 38,564. Okay, see that number?
Yep.
Yep. All right, so that is money that should actually be in your bank account. It's the cash that was generated over and above your payment. And you'll see I've got owner's withdrawal in there. So you've got owner's withdrawal, because I was treating this as a sole proprietorship, but yours would simply either say salary, okay, or most corporations will pay you a salary. That would be your plan, to get yourself to a point where you have a fixed amount of money every month. You may appear as wages right now, but that so that number of owners withdraw is going to come back as a sole proprietor, and it's actually going to bite you, because you would take the profit from the company as well as the amount that you withdrew, and that's what you'd actually be paid, would be taxable, that entire amount. Now, as a corporation, okay, the owner's withdrawal, 72,000. We're going to get into this a little bit more later, but of 72,000, if that's the money that you actually were paid by your corporation, then that's the amount that you have to pay the personal tax on. Okay. Now, I have to, we'll check as we go, but so you would probably be paying, and we'll look up for sure, somewhere between 20 and 26% taxes on that 72,000. Okay. The corporation, however, only pays 21% on its entire net profit. Right? So it's you got to do some real significant planning. Okay? Here's what an income statement looks like using those numbers from the cash flow statement. So the numbers that you see in the column are the total for the 12-month period of time under each of those line items. Okay? And when you go all the way down, I mean, it's pretty self-explanatory. You go all the way down to the profit and loss before tax. So the total profit that this company made was $42,660.96. Okay? That is different than the amount of cash that's in the company, because an income statement doesn't care whether some months you lost money or not. It cares on based on the revenue you brought in and based on the expenses that you incurred, am I profitable? Okay. You'll also see here that only the interest, so only $1,721 of that $10,000 loan payment is actually used on the income statement for tax purposes. And the other one is depreciation. And so depreciation here, it's $44,550 for the year, but that's the cumulative. So that's my furniture and fixtures, my computers, and my small equipment. Those are the three items that were used in this example. Okay, so they're all combined together to show me the total amount of depreciation. Now when we're talking about income tax brackets, so probably because of COVID, we haven't seen any changes in them since 2019, but we'll see. I'm sure they'll change. But if you're making less than $47,630 or less, then you actually are taxed at 15%. In your case, you were in the second bracket, having taken 72,000 out, so you're going to be taxed at the 20.5%. Okay? And it just continues to go up on a scale. So just to show you how that works. So your taxable income in this example is the withdrawal that the owner took, the 72,000, plus the profit at the end of the year. Okay, which gives you a total of $114,660. If you were a sole proprietor, you're paying tax on that entire amount. Okay, and so in this example, you would pay 20.5% on the first $95,259, and then on the balance of $19,401, you go up a bracket. Okay, and let me just take you back here for just a second. Just get that straight. Okay, so if you made, so in your case, you made $114,000 in this example.
Can I pause you for a second? I'm
Sure.
sorry to interrupt, but I got somebody that just came to the door that I was not expecting. So I'm just going to see what they're looking for and send them on their way.
Okay, can you pause us, Jenny?
This works, but second.
I'm just going to start our recording again. We're good to go.
Some kind of frozen food delivery service.
Oh.
Can you fix my truck?
Yeah, pretty much.
Okay, all right, you ready to keep going?
Absolutely.
Okay, I kind of forget where we were. Just a minute. Let me go back one. Because we just kept right on talking without you. Oh yeah, okay. Okay, so when you take a look at these, now this is, I was just saying to Jenny, this becomes important to you, and you'll see it as we go further along. So when you start making money in your company, you personally start getting paid in your company, then you need to monitor what your gross wage actually is. So when you get to a point where you're taking $47,630 out of your company, okay, but you need a little bit more, don't go to 50,000, because 50,000 bumps you right immediately into the next tax bracket. Do you see what I mean?
You pay 20.5% on the total 50, not just
That's right.
15% on the first 47 and then 20.5 on the 3,000 or whatever.
That's right, because once you break past the 630, the 47,630, then you're considered to be in that tax bracket. That's how they catch you. So if you're going to move from tax level to tax level, if you're making 47,630, you want to get yourself to a point where you're making 60 or 70. So you're halfway through that second bracket. So even though you're going to get taxed at a higher rate, you're still going to have more cash left at the end for yourself.
Yeah, I remember going through that once at where I was working, and I got a raise of 25 cents or 50 cents or something, and I actually ended up taking home $100 less a week. It was crazy. It was,
Yes, it's painful, painful, painful. Okay, so that's why I reinforce it to everybody, because they'll say, well, if I could make 50,000, I'd be happy. It's like, if you could make 50,000 and I take 20% of that, you're not even making 47 anymore. You know, so you really want to take a look at that, and don't automatically assume that your accountant will pay attention to those things for you. They won't.
Right.
Okay.
the only one
Okay.
I had a question on is this one where it's 20.5%. Oh, because it's up to 90. So they don't do the 15% on the first 47 and then 20.5 on the, okay.
No,
So it's the
because
first
you're
95.
already, it's based on where your taxable income lands. And so in this case, your taxable income lands in the next bracket.
The 114 is above, so they
Yeah.
only do the,
Just a sec, let me just show you. Okay, so, oh, I might have made it. No, 114 to 95.
114 should be in the 26th.
Yes, that's my error. So you would have been taxed the entire amount at 26%. There's no sliding scale there. Okay, it's where, yeah, I got to redo that slide now. It's where you actually land. So
Okay, so if it would have been under 95, you would have still paid.
then I would have gone back to the 20.5.
Oh, but would you have gone the 15 on the first bit?
Nope. Because it's, so if it would have been 90,000, let's say.
Yes.
Okay. If it would have been 90,000, I would have automatically landed in the second category based on my taxable income, because it's more than 47, but it's less than 95. So the entire amount, because I didn't exceed the 95, would have been taxed at 20.5%.
Okay.
Okay. Make sense?
Yes.
Kind of. Okay. So at the end of the day, this sole proprietor would have actually, now this is wrong numbers, but you'll get this, the general idea, would have actually lost more. So I'm just going to see what that would have really looked like. That actually would have been 29,000 if I would have put them in the right tax bracket to begin with, $811.60. That's how much they would have paid in taxes, okay, as a sole proprietor. Okay, as a business owner, well, just a few more things I just want to point out here. That 29,000 comes out of your personal pocket. It does not come out of the 42,000 that's profit in the company. That money is sitting in the company account. Now, the mistake that people make is that they think it's all theirs because they're all being taxed on all of it, and then they end up ripping the company because they take too much money out of it. So, and then it struggles to survive. Okay, so if this is you as a sole proprietor, okay, you would be looking at this and you would be saying, have I got the right business structure? Because I'm losing, I'm going to have to keep with this example because all my numbers are based on that number. Okay, I'm losing $24,572 to taxes, and therefore out of the $114,000 that I had to declare, only $90,087 is actually available, and $42,660 of that belongs to the company, not to me. So I would end up making $47,427, which would have kept me in the first bracket to begin with. So the question you always ask yourself is the money that I'm taking from the company what I actually need, or is it what I want? Okay, so if it's actually what you need, then that's what you take, realizing that you're going to, depending on the amount, that you're going to be paying taxes personally on that amount, so you're going to end up with less. Okay, so the calculation that you do is always, if it's, you know, $60,000 and I'm going to lose 20% of that, okay, then I'm gonna be paying, what am I paying? 10% of 10% of 60,000 is 6,000. Okay, so I would be 12,000 of that 60 would automatically be gone, and so I would only end up with 48,000. Right? So is 48,000 what I need to live on? If the answer is yes, that's what you need to comfortably have the lifestyle that you want, then you pay that taxes and you make sure you take that amount of money out of your account, okay, in the form of wages. In this case, this would have triggered to a sole proprietor that it is in their best interest to incorporate, because they didn't get the 72,000 even though they took that amount out. And whether they needed that much or not, they were being taxed too high. And so they would be better off in this case, if that would have been the case, as an incorporated company, the 72,000 would have been taxed at the 20.5%, but the 42,660 that belongs to the corporation, it would be taxed at 21%, instead of, in this case, pushing it total taxes into the 26% bracket. Do you see what I mean?
Yeah.
Okay, so you got to always be using your numbers to make as much sense as you possibly can of where your financial situation is. And you have to be sure that you have enough money set aside. Well, if you're salaried, okay, as an employee, all your taxes are going to come off anyway, all the time. So it's not going to be an issue about saving for that. But your company is still going to have to come up with 21% of the net profit. So you got to make sure there's enough money in there, because the government's going to be expecting it. And that's the mistake that people make, that they haven't bothered to take a look into what their pro forma statements or their estimates, their projections actually would anticipate them making, what the tax implication of that profit is, and making sure that that money is set aside for them. Okay, so you don't want to get caught. If this were real and that was a $24,000 bill, I could negotiate a payment schedule with Revenue Canada. But if I just failed to pay it, they can come in and take it, right? So they just seize your bank account and any of your assets. So, and that's where businesses get themselves into a lot of trouble. And in startups, it's not usually that much, but it's the $4,000 worth of debt that'll kill you. Okay. All right. Are you comfortable, before we move on to the balance sheet, are you comfortable with the income statement and the kinds of information that you would actually get from it?
Yes.
Okay. So your balance sheet is a totally different bird. Okay. It is actually just a picture at a specific moment in time. And so you'll always see the balance sheet will say as at October 31st, 2020, right? Because it's only good for that day. So that's important to remember, so that if you are going for financing, you want to make sure that you're going for financing when the health of your company, which is your balance sheet, is strong. Okay? There's only 3 items on a balance sheet. One is your assets, or what you own. Okay? The other is your liability, and that's what you owe. And then how much you have actually invested. And so when I look at the 2 types of assets, it's important to remember that there's some that are what we call liquid assets, or short-term assets, current assets, okay? And that means that I can usually turn them into cash within 1 year, okay? And so they're gonna, again, a banker or anybody looking at investing in your company is gonna be looking at these things and say, okay, how strong are they from a liquidity point of view? If you're looking for a loan, that's important, because they look at this and they say they're going to do a debt to equity ratio, but they look at this and they're going to say, okay, how liquid is this business? How stable are they? So if I give them a $50,000 loan, what are my chances of getting that money back? Okay? And so they look at all that you have and decide. Your fixed asset or longer term assets are things that usually take longer to turn into cash, and often there's less cash there. And that's things like your vehicle, or your equipment, buildings, computers, furniture and fixtures, goodwill, patents and trademarks. Patents and trademarks are worth something. They are valuable. If you have actually invented something or created something and put a trademark or a patent on it, that's money. That's real money. Goodwill, however, is something like a customer list. It actually has no exact value, because if I'm selling this business, I can't guarantee that my customers are going to automatically come to you. And if they don't like you, they're going to leave. So bankers often don't count goodwill, but business owners always do. Okay? So if we take your example in PA, so you had an upfront sale. Now, do you have an ongoing service contract with them?
There were 2 service calls included in the original purchase order, and those are completed.
Okay, but will they ever need to call you back again?
Not if I did my job right, but possibly. So they do have the service reports that I handed them show what the amount would be if they call me again. But there's no long-term contract that it's within their best interest to call me because I'm the one that built it. But if they want to hack and slash themselves and try to figure it out, then that's absolutely up to them.
Okay, did you ever discuss with them the possibility of putting in a standing order or a standing contract? One that says that you would do every 2 years or something, that you would come in and completely service the robot?
No,
Okay.
I haven't really thought of that.
So going forward, always try and negotiate that in. So this is the price of the setup. With the setup, you get 2 service calls, because things could just go wonky in the beginning. And then there's an additional charge. Every 2 years, you would go in, or every year, I don't know enough about robotics, you would go in and do a complete update or overhaul or whatever to make sure that it continues to operate efficiently. And that additional contract is X numbers of dollars. Okay? That's called a standing contract, because it exists beyond the sale of the actual product. And it would be identified here under goodwill. But now that goodwill actually has a dollar figure attached to it. Okay? am I making myself
Yep. No,
clear?
that's, yep.
Okay,
Like
good.
I said, they were new to robotics and whatnot too, and they weren't sure what to actually expect from that. So
Yeah, but now they're
I
pretty
mean,
excited.
oh yeah,
Yeah.
it
But
actually went down.
like
It
any
went down
machine,
to,
that robot is actually going to wear out one day,
yep.
you know,
Yeah,
so go ahead.
it was kind of funny because it actually did go down. They had a power outage or something, and they shut off their compressor and whatnot, and it was down for 2 hours. So they had to stock by hand for the couple hours. So the guys that at first were kind of skeptical about the robots were more like, let's hurry up and get this thing going again, because they
Yeah.
couldn't stand stacking for 2 hours.
No kidding. A good lesson learned.
Yeah.
Frozen food guy back?
No, just right next to this window and the sun's beating in now.
You okay to keep going?
Yes.
Okay. All right. So the other part of the next part of the balance sheet is called your liabilities, and that's everything that you owe. Okay. So you have, again, short and long term liabilities. The short term liabilities are things that have to be paid off within the next 12 months, if or sooner. Okay. So accounts payable. If you leave a bill outstanding for more than a year, you get registered with credit bureau. They're still going to try and collect it, right? But you're not going to get a good rating. So your accounts payable, you have got to make sure that you are paying your suppliers on a regular basis. Okay. The next one is the principal. Okay, the loan principal payments for that year. Okay, so if you go back to our example, the loan payment was 10,000 something, and you subtract from that the interest, then what goes on your balance sheet, which you'll see in a minute, is the principal amount that will be paid off on that loan in this year. Okay, and then of course any taxes owing. So here it could be things like, it would be things like your GST, if you had the GST number. If you're making more than $30,000, you should have a GST number by law. Okay, so that would be GST payable or PST payable. That's what kind of taxes we're talking about. Okay, that go on there. The long-term liabilities is the balance of the loan owing after the year, after that year of payments have been made. Okay, it could be any mortgages that you have on property, and in your case, it could be a shareholder's loan. So if you actually have to give money to your company, okay, to keep it operating, for example, that's a shareholder's loan, and that's how it gets registered on your books. That shareholder's loan can come back to you as a non-taxable item to you, because you actually gave the money to the corporation. If it's your money, you've already paid taxes on it. So when you take it back, there's no income tax charged on it. Okay? So it's a way for you to build some wealth within your company. It's like having your own tax-free savings account. All right. And your owner's investment, and this is what we talked about just a little bit earlier, it's any cash that you invest into your company. Okay, so you'll see on the balance sheet, it's going to show as a cash investment. If it was, because this is a sole proprietor, if it was a corporation, it would show as a shareholder's loan. Okay, any equipment that you gave them, that's why I was asking you about the laptop and things like that, because if you'd have bought it and given it to them to use, then you need to get recognition for what you've contributed to your business. And then of course, whatever, buildings and things like that. At the end of the day, your balance sheet must balance. And what that means is that your assets, both your short and long-term assets, must equal the short and long-term liabilities plus the owner's equity. Okay? Okay. So using the numbers that we had, if you take a look at it, that cash amount came from the cash flow statement, because that's the money that actually got deposited into the bank, not the 42,000, because you had months where you didn't actually earn enough to pay for all the bills. Okay. The accounts receivable, which is money that's owed to you for services that you've done and you have not got it yet. Okay. Then you go down to your long-term assets, and the number in red is the amount that was depreciated in that year. And so for furniture and fixtures, 5,000 less the depreciation of 1,000 gives you that 4,000. Okay. And you do the same for equipment, small equipment, and you do the same for computer equipment. So my total assets are equal to $56,000. Okay. My short-term liabilities is the $8,646.96, which is the total amount that I paid for the loan on the cash flow statement minus the amount that appeared, the interest on that loan that appeared on the income statement. Okay. And my long-term debt is $41,353.04, which is $50,000. Okay. Because that was the amount of my loan. So it's, my loan was 50,000. This year I've paid off 86 and I still owe 41. Okay. To see how those numbers make sense. Okay. And in the beginning, I invested $6,000 cash, okay, to get everything started up and running. So my total assets are 56,000. My total liabilities and owner's investment is 56,000. Is that making sense? Okay.
So is there a benefit to having it as a shareholder's loan as opposed to just being paid back for what you've put in?
No,
Or is that just how it has to be identified in
it just needs to be registered. Yeah. Okay. Somewhere it needs to appear so that it can be scrutinized. Okay. Otherwise, it looks like you got paid that amount, but really it's coming back to you tax-free, right? Because it's just a temporary loan.
Right.
So your accountant at the end of your first year will probably clear that up, or may completely ignore it if it's all been paid back already. Then it doesn't have to show that it went into the company and then came out of the company. But that's for them to decide. Okay, when you take a look at the balance sheet, the kinds of things that you're looking for, okay? So the first one is the accounts receivable. Actually, no, first one is accounts receivable. That tells you whether or not you have good policies in place. And so if your accounts receivable is large, and you look at it and say, well, gee, some of these guys haven't paid me for like 90 days or 120 days, that means you have a very weak accounts receivable policy. So you need to then make sure that on every invoice that you send out, there is a penalty for late payment. And you have to have that rate written right on the receipt, whether it's 2% per month or 2% per annum or whatever. You just have to make sure that it's there, and they have to know. The other thing that you want to, because the investment that someone is making with you, especially if they're buying a piece of equipment, that's a huge expenditure for you to try and cash flow. And so there should always be a policy in place that says at least 50% down. So you might not get paid for your labor up front, or not
Basically
all of it.
exactly how we did it.
Yeah.
Yeah,
It
we
is.
did 50, 25, and 25. So 50, 25 when it was ready to be bought off on our floor, and then another 25 after it was on their floor, and they were happy.
Good. So that's really good. So that's what you want to be paying attention to, that you never make your company cash poor, ever. Okay. And you want to keep building on that cash, on that amount of wealth. If you get into a position where you have to start to carry parts and inventory, okay, you want to make sure that you're monitoring the size of that inventory and the actual value of that inventory, because you're involved in technology and things could change. Now, I'm sure, but be like anything else. I mean, if you have an old robot out there, you got to still have some parts to repair them. So even though there's a new version or second or third generation of that same robot, the first robot you still have to repair. But you maybe only need to have one part, not 6 of them sitting on the shelf. Okay. Again, you're just going to monitor changes in the accounts payable. Now, the one that comes up quite often in companies is GST. So in your first year, you probably won't have to file your GST until the end of the year. But there will be a monthly amount that would show up as GST payable, because you're going to have to pay it at the end of the year. And so you want to make sure that you're going through that calculation on how do I figure out my GST. Okay. It's going to help you with some financial planning and just little things like, well, there are things that you can do in a corporation that you can't do in a sole proprietorship. And so for example, as long as I am profitable as an incorporated company, I can actually to defer. It's just to defer. It's not to avoid taxes, because that's illegal. Okay. So to defer taxes at the end of my fiscal year, I can pay out a bonus to me if I'm the owner like you are. So your corporation can pay a bonus out to you equal to the first 6 months of your wages. Okay. So therefore, I'm deferring 6 months of taxes that the corporation won't have to pay. It eventually will have to pay, you know, as I retire or things like that happen. Eventually, I would stop paying out a bonus, and then it would catch me. But it's deferred until such time. And you can do that every year. Okay? As a sole proprietor, you cannot.
Are
Now,
there corporations that do that then, that's how they pay themselves? But you're saying it's only a percentage of the wages.
So if you're taking $5,000 a month out of your company, over 6 months, that's $30,000. So at the end of the year, to reduce the amount of tax that the corporation has to pay, just remember your corporation is separate from you, right? So you're two different people. You're taxed at a personal level, they're taxed at the corporate level. So the corporation can take from itself 30,000 maximum of $30,000 and pay it to you in the form of a bonus, as long as the amount that they give you does not exceed the next 6 months of wages. Otherwise, for you, it becomes your wages plus the $30,000 bonus that you personally pay the taxes on. See what I mean? Okay. So you need, and work with your accountant to make sure that that's done properly, because the idea is just to defer tax payable, not to end up getting hit with a high tax bracket. Okay. And as we said before, this whole idea of when you should purchase additional assets as stuff starts to wear out, it gives you a warning sign and tells you, hey, heads up, you better put aside a little money because we're going to need to buy this. Okay. And the most important one is the liquidity of the company. So if I just, just got to go back. Sorry, just for a second here. Not exactly sure what will happen, but I'll figure it out.
Probably just have to reshare.
Yeah, I just, but I actually closed out
Oh,
of the.
closed out, okay.
So now I got to find the slide I was on. I'm not exactly sure how I ended up being able to do that. Okay, I can't see the share button.
Okay, well, let me make sure that you still, you are the host. Did your screen slide down and cover up the share button?
Well, like, yeah, but usually I can make it pop up.
If you hover over? I'm just gonna make sure. Yeah, because it's still saying that you have permission to share.
Okay, just a minute. I know what I might have done. I'll end the show.
It's like all technology. It's wonderful while it works, until we hit the wrong button.
Okay. I think what I needed to do is get back to this screen.
There we go.
No, that, anyway. When we talk about liquidity, right? And how you measure liquidity. So this is what we're looking at, is just the very top of this. So how this company in this particular situation has $44,550 available to it immediately if it needed to. I mean, it would have 38,000 that it could go to the bank and take out immediately, and it would have just about 6,000 that it could start trying to collect. So that's when we talk about measure your liquidity. But I also said that the balance sheet is only at that moment in time. So this is a picture of the health of this business at this moment in time. If I go out and spend $20,000 on a piece of equipment that I want, then all of a sudden my liquidity changes because the equipment goes into longer term assets and they're harder to sell. Okay? See what I'm saying? So when we talk about measuring the liquidity, that's what you want. So if you're going for financing, you want to make sure that you're going for financing at a point where your company is the strongest, where the liquidity of the company is strong. And your goal is to build up that cash account, that bank account, whether you put that, turn around and put it in term certificates or something so that you can cash them later, but at least generate some interest off the money. You need to make sure that you always have enough money to continue operating and paying your bills for at least 3 months. Okay, so that's your goal. Eventually, you'll want to make sure that there's enough money to cover the cost of operating for a year, because that's your safety net, right? So if you all of a sudden lost all your contracts, let's just say, okay, the company still has money to operate, so therefore you still continue to get your money, your wages. And that may be the one thing that protects you over time. Or if you're ever going to wind down your company. When you wind down your company, that money becomes yours. It's taxable to you as an individual, so you can actually take it out in smaller chunks as you're winding down. There's nothing that says you have to wind down in 24 hours. Okay, so even these businesses that are closing over COVID, they started that process when they first had to close their doors, because they were probably very aware that it was going to be too difficult for them to become profitable again. And so they were ensuring that they, in fact, were able to take care of themselves over that crisis period. Okay? Oops. And that's it. That all makes sense to you?
Oh yeah, that's just easy. Oh yeah.
Okay, my speaking notes are written on the bottom of these slides, and so when you receive it, some of it is a duplicate of what's on the actual screen. But when you receive it, you'll see some of the other things that I might have been talking about. But if you have any questions at all, you can just give me a shout on my cell phone. you know, text me if you want, and then we can pick up a time and we can meet on Zoom. If there's some things that maybe all of a sudden after you've processed all this information, it's like, oh my God. But you can go back into YouTube. They'll be uploading it, and you can watch it as many times as you need to, and bring up whatever questions.
Well, I'm sure I'll have a